Hi everyone. So we're going to discuss a stock today that we actually own in our client portfolios. The company is the largest global footwear and apparel corporation. You all know it. I think almost everyone in the world is familiar with their swoosh logo. Yes, it's Nike, ticker symbol NKE. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. So this video on Nike should not be considered a recommendation to buy or sell the stock, but we hope as we evaluate this company that for educational purposes, you'll understand a little bit better about how we think and understand the investment framework that we use here at YCG. You know, in a crowded, competitive world where time is an ever scarcer resource, people desire filters that can help them quickly identify high-value collaborators. By creating belief networks that connect their brands to certain characteristics, luxury goods companies provide consumers with valuable filtering tools. Nike has created one of the most robust luxury goods belief networks ever. Through savvy marketing, impressive design, and a storied heritage, Nike has cultivated a brand that many consumers believe stands for the epitome of athleticism, power, fitness, wealth, and coolness. The strength of this brand is evidenced by both its size and scope. The Nike brand is globally recognized and in fact is almost akin to a global luxury language. The brand is so strong that the company has successfully attached it to a variety of product areas, everything from sneakers to athletic apparel to fashion and fashion accessories, each of which is a large and rapidly growing revenue generator for the company. Moreover, the company has spent billions to create a storied heritage that connects their brands to legendary athletes, teams, celebrities, and centers of culture and competition going back to its founding in Oregon in 1964. This heritage aspect is particularly important since new brands can't go back in time and create a heritage, putting them at a huge disadvantage versus incumbents such as Nike. As a result of its strength as a people filter, we believe Nike is likely to grow both its volume and pricing power over time, particularly as billions more people are added to the global middle class and the value of their belief network likely grows even stronger. Even if competitors create virtually identical products for the aforementioned reasons, we believe Nike will be able to continue to sell its products at a premium. Furthermore, because the Nike brand serves as a signal of athleticism, power, fitness, wealth, and coolness, and this signal is only reliable if it is costly to send, Nike has to raise its prices as wealth increases in order to maintain the brand's value proposition. The company's operating segments include the world pretty much. Its portfolio brands include the Nike brand, Jordan brand, Hurley, and Converse. As of today, the company has focused its Nike brand product offerings in 9 categories: running, Nike basketball, the Jordan brand, football or soccer, men's training, women's training, action sports, sportswear, and golf. So with that, let's switch over to Refinitiv and look at Nike from a quantitative side of things. This is just a really basic analysis of Nike. Unfortunately, we don't have enough time to cover the kind of depth we go into before deciding whether it's a stock suitable for client portfolios. We did write a comprehensive investment letter on our thesis for owning Nike back in 2016, and you can find that link in the description below if you're curious to read it. Okay, let's jump right into Refinitiv then. Okay, so here we have Nike trading at $132 a share. Stock price is up today. Obviously, headquarters are in Beaverton, Oregon. Pretty amazing. Their employees now at 75,400 employees. So just a massive company from an employee standpoint. Let's take a look at their capital structure. So trading at $205 billion with their market cap, cash and equivalents and short-term investments add up to about $12 billion, with about $9 billion in total debt. The company obviously spews off tons of cash, so definitely able to kind of service its debt debt with its excess cash flow right there. We're going to actually skip this section here on the key ratios because we're going to look at that using kind of our investment framework. But the one thing that I will point out is return on assets. Return on assets, last year's fiscal year was about 9%. This next fiscal year projected to be about 15%. I'll say that this is return on assets, not tangible assets. Return on assets, so it includes intangibles as well. But return on equity, very strong, 29%, looking to be about 52% going in the next, 57% in the next couple of fiscal years looking forward. Let's take a look at the price of and the stock chart of Nike. So here, year-to-date performance about down 6.5% when looking at on a year-to-date basis. This is the chart from 1 year ago. Let's expand this out. From 5 years ago, back in 2017, stock was trading around $53 a share, and now trading at about $132 a share. All right, let's keep going down here. So trading, looking at the last 12 months, which is pretty somewhat irrelevant, but the price to earnings ratio trading at about 61 times. When you look forward, it's actually a lot less than that. Let's take a look at our gross margins. I know we talk about gross margins being a very good indicator of pricing power. And as you can see, fiscal year of last year, about 43%, very consistent. Looking at this next year's fiscal year, looking at about 44%, 45% in fiscal year. I think that's 2022. And then in 2023, looking at about 46% in gross margins. Very, very strong. All right, let's talk about the earnings report that's coming out this afternoon. So let's actually go there. Refinitiv has this great feature where you can actually take a look at kind of the custom calculated mean of the earnings per share. And it looks like the smart estimate that Refinitiv's calculating is that they're going to report about a 52 cents a share EPS. The mean is at 51. And right now there's a predicted surprise of about 2.26% with regards to the earnings. Now, we look a lot more long-term. We kind of look at Nike as in terms of 10, 20 years, 30 years out from here. So 1 quarter is kind of a very short term. Who knows? It could surprise on the upside. It could surprise on the downside. But with things opening up, sports events, athletes now performing. This is a very exciting time for Nike to kind of get back into its normal flow of business. And so we'll have to see what the earnings report that they'll publicly announce today, this afternoon. But there you can see kind of the estimates of what they're expecting to report today. Okay, so we're back here to our EPS growth. Revenue, by the way, looking to generate about $11 billion in revenue for this next quarter. So again, we'll have to see how that report shakes out. All right, let's go actually down to the business segments. I really think this is super fascinating to take a look. We're looking at revenue here for 2020. North America comes up to about 38% of the revenues for Nike. Europe, Middle East, and Africa is about 25%. Very strong category of growth. Greater China, this is probably one of their strongest places of growth. About almost 18% of revenues. Asia, Pacific, and Latin America, about 13%. Converse, by the way, is about 5% of their revenues. All right, as far as top investors, it's just the large players that we typically see from that perspective. Here we can see the peers. Under Armour is definitely kind of a competitor that you think about. What's just amazing to me is the size differential. The market cap of $205 billion versus just $8 billion with Under Armour. Interestingly about Under Armour is about 60% of the revenues for Nike come from footwear. And it's completely the other way around. About 60% of Under Armour's revenues come actually from clothing. And with shoes being worn out faster than clothing, Nike has definitely an advantage there, where people are consuming shoes more regularly than I would say than apparel. There's definitely more margins to be made in footwear than apparel. Interestingly, here you can see enterprise value over EBITDA for this next year's fiscal year, trading, and this basically is a valuation metric to look at. Enterprise value basically is if you were to buy and take that company private and assume that debt, that's what we mean by enterprise value. And then you divide that over the earnings before interest, taxes, depreciation, and amortization. You get basically a price to earnings ratio. It's a valuation metric that you can look at. And here, looking at next fiscal year, Nike trading at about 29 times and Under Armour trading at 19 times. And you'd think, well, you know, Under Armour is a lot cheaper than Nike. Why don't we just buy the Under Armour? But there's something to be said about the amount of cash flow and the consistency of that cash flow that Nike commands, and just the amount of cash flow it can spend on marketing. It just outspends Under Armour and is able to generate higher returns and just has that higher pricing power capability, as demonstrated by the gross margins that I just showed of 44-45%. If you want to learn more about our entire investment strategy framework, we have a video for that, and you can check out this link up here. As is often the case with such dominant high return on capital businesses, Nike generates excess cash flow in droves with a very strong balance sheet and consistent returns of capital to shareholders. You know, the athleisure sector has historically seen impressive growth over the last decade, and many believe could grow even faster as wealth rises globally. Of course, none of us have a clear picture of what the future will look like. But here at YCG, when we're looking at terminal growth rates, which by the way the definition is for that is it's a constant growth rate that a company is expected to grow at for basically forever, which is estimated when using some kind of a discounted cash flow model. So while a company may be growing faster now, what we really are trying to think through is, first, will this industry maintain or grow its share of GDP over time? Or will it shrink as a percentage of our overall budgets over time? And two, can this company maintain or grow its market share in the industry over time? If the industry is growing at least as fast as GDP and the company has pricing power, then it will essentially have built-in growth that's indexed to grow at GDP or better. So coming back to the athleisure industry, which according to Grandview Research forecasts this industry to grow over 8% from 2019 to 2025 as a whole, much faster than overall GDP growth. In our opinion, we don't see that changing anytime soon. Of course, always please consult with your financial advisor regarding your own circumstances. For Nike, we see some growth coming from population growth, both growth in the number of people they sell to as they expand overseas, as well as actual population growth in each of those markets. There could also be some growth from market share taking, but we recognize the fierce competition Nike faces, so they could also lose market share, but we definitely see continued growth in pricing, which is both a function of their pricing power as well as them simply keeping pace with inflation. On top of all of this, there could be some growth from margin expansion as they expand their more profitable direct-to-consumer channel, and as they grow and scale larger. In other words, they have the same administrative expenses amortized over more sales and an advertising endorsement budget that grows slower than their growth in revenues. The most exciting opportunity is their incredible brand strength and growth happening over in China. I think what would be helpful at this point is to look at the definitive quantitative numbers, but to put them through our YCG investment framework. Okay, so let's take a look at Nike through our investment framework here. So let's take a look at the competitive advantages. Obviously, massive global belief network from a social status element, and it's clearly a leader in its category of athletic footwear, apparel, and accessories. Very strong network effect. Is it a global network effect? Yes. and absolutely high switching costs from a social status element. When we take a look at enduring pricing power, we believe that it has pricing power as demonstrated by its margins, but also we believe it's enduring because of that high switching cost, that global network, where it's just a language that speaks to social status. Morningstar moat rating has it as a wide moat rating because of that, has exemplary capital allocation, and fair value uncertainty is medium. It's obviously in the large cap growth category from that perspective. All right, so let's dive into the numbers here. We skipped that part in Refinitiv, but because I knew that we were going to get here to looking at the Refinitiv numbers through our investment framework here on these slides. So Nike, it's trailing 12 months gross margins at 46%. Estimated gross margins at 44%. The trailing 12-month operating margins are at about 11%, and approximately returns on capital employed at 16%, ROIC, or returns on invested capital, about 13%, returns on assets about 9%, and its expected return on equity is about 30%, so very high. So obviously Nike does have debt, but it has a net cash position. It has more than enough cash to service that debt, so we're not worried about that in any degree. Total enterprise value is about $154 billion. Again, enterprise value is that value of the company if you were to take it private and assume all of that debt. That's what we mean by enterprise value. And looking at the next fiscal year's revenue estimates, about $43 billion. So if we're looking at any kind of valuation metric, enterprise value over the next fiscal year's sales, about 3.6. So a little bit more on the high side. Historically, I think it's actually enterprise value over sales has averaged about 0.75. So you're thinking, whoa, 3.6 is really a lot higher than that. But actually with margin expansion, businesses becoming more capital light, more service oriented, you could make the argument that 0.75 actually should kind of be ratcheted up. And I think the average right now is about 2 times sales. So that's kind of an interesting valuation metric to take a look at. Price over the next 12 months earnings, about 34 times. And enterprise value over the next fiscal year's earnings before interest and taxes, about 35 times. So we always ask the question, would YCG consider this as an investment? And the obvious answer is yes, it's an existing holding for us, for our client portfolios. All right, so let's do a stock comparison. Here we're looking at Nike versus Under Armour, obviously a very strong competitor against Nike. Here we can see the price of Nike at $130 a share. We take the next 3 years earnings per share estimate, about $3.92. Very capital light business, so a lot of cash flow available to pass on to shareholders. So I assumed about a 90% payout, which gives you a yield of $3.53. That gives you about a free cash flow yield of about 2.7%. Now, typically we've kind of said, terminal growth rates of about 5%. That's not actually, precise from that perspective, and growth rates are always very difficult to predict anyway. But given that the fact that the athleisure sector has grown at about 8%, if you factor in deflation and other metrics, and going out in the very long term, we've tacked on a growth number about 6.4% for Nike, which actually gives you a forward rate of return of about 9.1% for Nike. So very strong forward rate of return, even at today's prices, which is why we believe it's a position worth having in our client portfolios. When you compare that to Under Armour trading at about $17 a share, earnings about 38 cents, but it's all over the map. You can see it was negative $1.24 last year, and it was about 20 cents in 2019. The fact is, Nike is such a behemoth and such a massive competitor. It's very difficult for Under Armour to compete in a similar fashion. So anyway, if you assume the same payout, 90% here, 34 cents is kind of your shareholder yield, which gives you about a free cash flow yield of about 1.9%. Under Armour is definitely struggling with its growth. So I would say that, long term, let's just assume that it's going to grow with inflation, or at GDP, rates of GDP, I should say. So I assumed about a growth rate of about 3%, which only gives you a forward rate of return of 4.9%. So given that, we definitely favor the kind of the leader of the category, and that's clearly Nike. We frequently discuss our desire to own businesses that participate in inflationary rather than deflationary categories, such as selling computers and TVs, which have dramatically decreased in price over time. Oftentimes, this is found among goods that convey social status, such as in our holding of Nike. As global wealth increases, discretionary income increases, allowing pricing power as consumers with insatiable appetite spend more dollars on luxury goods to try and prove that they have the ability to command more resources than their neighbors. In many ways, Nike has become a luxury goods business, as evidenced by Nike being listed among the most counterfeited brands in the world. So what are your thoughts on Nike? We'd love to hear your opinions in the comments section below. As mentioned earlier, we do own Nike in client portfolios, and you can request a complete list of all the securities recommended by YCG in the last 12 months by reaching out to us. Thanks for joining us today. Check out our other videos, and we'll see you next time. Thanks for watching.